Welcome to the TaxSlayer Pro Income Tax Preparation course. This is Module 1 for 2018 tax returns, filing requirements, and filing status. So how did it all come to this? Why are we here? Well, according to the history of the income tax, taxation became a way of life in the United States after the Revolutionary War. The United States was faced with a tremendous war debt and a need to create economic stability. As a means of funding these financial issues, Congress placed an excise tax on the sale of whiskey. Farmers in western Pennsylvania felt that their livelihoods were threatened by the tax, and many refused to pay it. As a protest to the tax, the farmers took part in what's known as the 1794 Whiskey Rebellion. President George Washington sent militias into western Pennsylvania, and the rebellion was defeated. In 1862, President Abraham Lincoln and Congress passed the first federal income tax law to support the Union's Civil War effort. The Revenue Act of 1862 was repealed in 1872, revived in 1894, and then declared unconstitutional by the Supreme Court the following year. In 1913, the 16th Amendment to the Constitution made the income tax a permanent fixture in the United States tax system. So why is the form called a 1040? Well, one theory says that in the year 1040 BC, Samuel, the last of the prophets, gave in to his people's demands, that he give them a king, but he warned them that a king would require them to pay taxes. Then there was the year 1040 AD, when Lady Godiva is said to have ridden through the streets of Coventry, England, protesting taxes. But there's no magic. On October 3, 1913, the Bureau of Internal Revenue unveiled its form for the new income tax. It was named Form 1040, simply as part of the agency's normal sequential numbering process. Form 1039 had already been taken. The 1913 Form 1040, as you see here, was 4 whole pages, which included the instructions. The federal tax code is 187 times longer than it was a century ago. In the first 26 years of the federal income tax, the tax code only grew from 400 to 504 pages. Even through President Franklin Roosevelt's New Deal, the tax code was well under 1,000 pages. But changes during World War II made the length of the tax code balloon to 8,200 pages. Most of the growth in the tax code has come in the past 30 years, growing from 26,300 pages in 1984 to nearly 3 times that length today. In December of 2017, the Tax Cuts and Jobs Act was signed into law. This was called the most dramatic change to the tax code in more than 30 years. Republican congressional leaders claim that the act will spur economic growth and cut taxes for working families. Because of that, we have some retired forms. The 1040A has been retired, the 1040EZ, and the Form 2106EZ, unreimbursed employee business expenses. Let's go through some of the changes because of the Tax Cuts and Jobs Act from 2017 to 2018. We'll go into these changes in more detail as we go through the 1040 and we go through the tax course, but here's a brief overview. First, the child tax credit. The prior law, 2017, was a $1,000 credit per child, refundable up to $1,000. For 2018, it's been increased to $2,000 per child and refundable up to $1,400. The individual tax rates have changed. 2017 we had a 10, 15, 25, 28, 33, 35, and 39.6% individual rate. The 10% rate is still with us for 2018, but we now have a 12, a 22, a 24, a 32, the 35% rate is still with us, and the 39.6% rate has dropped to 37%. The standard deduction has almost doubled. Married filing joint in 2017 was $12,700, has gone up to $24,000 for 2018. The single standard deduction was $6,350 in 2017, has gone up to $12,000. The head of household standard deduction was $9,350 in 2017, has almost doubled to $18,000 for 2018. The corporate tax rate, 2017 was a 35% maximum rate. For 2018, has gone down considerably to a 21% flat rate. Pass-through income, the same as individual rates. For 2017, we now have a new, what they call QBI, a 20% deduction for 2018 for pass-through income. The alternative minimum tax for 2017 for individuals was 26 and 28% and a corporate rate of 20%. The individual, the exemption, getting you out of the alternative minimum tax is increased. The corporate alternative minimum tax has been repealed. Personal exemptions, $4,050 per person for 2017. There are no longer any personal exemptions in the 2018 tax return. State and local taxes for 2017 were fully deductible. We now have a $10,000 cap, a maximum $10,000 deduction for state and local taxes. Mortgage interest. For 2017, there was a $1 million limit on mortgage debt, and this has gone down to a $750,000 limit on mortgage debt for 2018. So to put it another way, interest payments are deductible on mortgage debt of up to $750,000, and this was formerly $1 million. The new 1040, the new Form 1040, uses a building block approach, allowing individual taxpayers to add only the schedules that they need to their 2018 federal tax return. Taxpayers with more complicated returns are going to need to complete one or more of the new Form 1040 schedules. And again, we'll go into these schedules in more detail as we go along. This group of taxpayers includes those who claim certain deductions or credits or who owe additional taxes. Individuals who filed their federal tax return electronically last year may not even notice any changes, as the tax return preparation software will automatically use their answers to the tax questions to complete the Form 1040 and any needed schedules. For purposes of this course, we'll be using the 2018 tax laws, and we're going to be working only with the Form 1040. As we said, the 1040A and the 1040EZ have been retired. We're going to make our way through the 1040, but in the interest of time, we may skip some sections and schedules, those that are not used as frequently. Working through a few examples, we're going to eliminate the intimidation factor that this form, the 1040, holds over most of our heads. Again, keeping that building block idea in mind, the 1040 this year for 2018 is much shorter than it has been in the past. We didn't quite get the postcard 1040, but the 1040 for this year is only 23 lines. Divided into sections, we've got the filing status, the name and address section, the dependents section, and the signature section. And then on page 2, again, if you notice, the 1040 is only 23 lines now. We've got the income reporting and tax calculation section and the amount you owe or refund section. Let's take a look at Form 1040, Schedule 1. Now, Schedule 1 is for taxpayers who have additional sources of income, not from a W-2, or adjustments to income, such as IRA contributions, student loan interest, and health savings account contributions. And remember, on the 2017 1040, these amounts were right on page 1. But now we have a new schedule, Schedule 1. Schedule 2 for taxpayers with some other forms of tax, such as alternative minimum tax, for example. Schedule 3 for non-refundable credits, the foreign tax credit, credit for child and dependent care expenses, education credits, and so on. Schedule 4. This schedule is where taxpayers will add up certain taxes, such as self-employment tax, uncollected Social Security and Medicare taxes, and others. Schedule 5 is to add up tax payments, such as estimated tax payments or amounts paid with an extension. Schedule 6 is where the taxpayer can appoint a third-party designee to discuss his or her tax return with the IRS. Now let's quickly go over some of the filing requirements for 2018 tax returns. Who should file a return? Well, anyone who meets the filing requirements. Someone whose refund of taxes was withheld, you definitely want to file a tax return to get a refund. And anyone who has a refundable credit. Also, someone who may recapture prior credits. Anybody who owes special taxes. Anyone who received distributions from an Archer medical savings account, Medicare Advantage MSA, or a health savings account. Someone who had net earnings from self-employment of $400 or more. Anyone who had wages of $108.28 or more from a church or qualified church-controlled organization that is exempt from employer Social Security and Medicare taxes. Filing requirements for most taxpayers are based on filing status, age at the end of the tax year, and gross income. Gross income is all income received in the form of money, goods, property, and services that are not exempt from taxes, including income from foreign sources. Filing requirements for most taxpayers. Now, if your filing status is single and you're under 65, then you need to file a return if your gross income was at least $12,000. I'm not going to go through every filing status and number in this table, but we'll just hit some of the highlights. Married filing jointly under 65. Need to file a return if your gross income was at least $24,000. Head of household under 65, you'll need to file a return if your gross income was at least $18,000. And you notice that these numbers marry up with the new standard deduction amounts. And here they are, the 2018 standard deductions amounts. Like we said, single $12,000, married filing jointly $24,000, married filing separately $12,000, and head of household $18,000. As we said earlier, in recapping the 2018 tax law changes, the exemption amount is now 0 for 2018. No more personal exemptions. For a single dependent, are you required to file? Were you either age 65 or older or blind? No. You must file a return if any of the following apply. Your unearned income was more than $1,050. Your earned income was more than $12,000. Now let's talk about filing status. And notice up here on the new 1040, the filing status is on the very top line. The filing status is determined by the taxpayer's marital status on December the 31st. There are five filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying widow or widower with a dependent child. First, the single filing status. You must be unmarried on the last day of the year. You must be legally separated by divorce or a separate maintenance decree, or you don't qualify for another filing status. Married filing jointly can be used if on December the 31st, the taxpayers are married and spouses are filing a joint return even if one had no income or deductions, are living together in a common law marriage that is recognized in the state where the taxpayers now live or in the state where the common law marriage began, are married and living apart but not legally separated under a decree of divorce or separate maintenance agreement. You can file jointly if you experienced the death of a spouse during the tax year and did not remarry before the year's end. You can file jointly if you experienced the death of a spouse during the tax year and remarried before the end of the tax year. You would be filing married filing joint with the new spouse. The deceased spouse's filing status would then be married filing separately for the tax year. Next, let's consider the filing status for same-sex married couples. Taxpayers of the same sex are considered married if they were legally married in a state that recognizes same-sex marriages. They'll be treated as married for all federal and state tax purposes, including income, gift, and estate taxes. The taxpayer and his or her spouse must use the married filing jointly or married filing separately filing status on the federal return. Taxpayers who entered into a registered domestic partnership, a civil union, or any other similar relationship that is not defined as a marriage under state law are not considered married for federal tax return filing purposes. Now let's look at married filing separately. In this case, each spouse files an individual return claiming his or her own income and exemptions. Taxes are generally higher for this filing status. Some credits are unavailable, some credits are reduced. Some taxpayers file separately in order to avoid a potential refund offset due to a spouse's outstanding debts or bad behavior. This filing status can be used if on December the 31st the taxpayer chooses this status, if he's married, living together, or apart, wants to be responsible for only his or her tax, or chooses this status if it results in less tax than he or she would owe on a joint return. Some of the rules regarding the married filing separately filing status: you must itemize your deductions if the spouse itemizes. If the taxpayer itemizes, the spouse must itemize as well. You can't deduct student loan interest under the married filing separately filing status. You don't qualify for the earned income credit. And you can't take credit for child and dependent care expenses in most instances. The amount that can be excluded from income under an employer's dependent care assistance program is also limited to $2,500. Continuing on with the rules, you can't take credit for the elderly or disabled unless they lived apart for the entire year. You can't take the education credits. You can't take the adoption credit if you're married filing separately. And the amount allowed for child tax credit and retirement savings contribution credit will be reduced. The taxpayer may be required to include more Social Security or railroad retirement benefits in taxable income. You can't roll over amounts from a traditional IRA into a Roth IRA during the year that the taxpayer and spouse file a separate return. Under married filing separately, you'll be limited to a capital loss deduction of $1,500 instead of $3,000 for the married filing joint filing status. You may not be able to deduct as large a passive activity loss if you file separately. Tax rates, again, are generally higher than on a married filing joint return. The exemption amount for figuring the alternative minimum tax, the AMT, will be half of that allowed to a joint return filer. And you can't exclude any interest income from U.S. savings bonds that were used for higher education expenses. Next, the head of household filing status. You must be unmarried or considered unmarried on the last day of the year to use this filing status. You must have paid more than half the cost of keeping up a home for the year, and a qualifying person must have lived with you for more than half the year. So what does it mean when we say considered unmarried? Some married taxpayers who live apart from their spouses and provide for dependent children may be considered unmarried for tax purposes. These taxpayers are permitted to file as head of household and receive the benefit of these lower tax amounts for filing head of household if they file a return separate from the spouse for the tax year, paid more than half the cost of keeping up a home for the year, lived apart from their spouse during the entire last 6 months of the tax year. The spouse is considered to have lived in the home even if temporarily absent due to special circumstances, such as military service or education. And taxpayers are permitted to file as head of household if they provide the main home for more than half the year of a dependent child, stepchild, or foster child placed by an authorized agency. The costs included in maintaining a household are rent, mortgage interest payments, real estate taxes, homeowners or renters insurance, repairs, utilities, food eaten in the home. Costs that are not included are clothing, education, medical treatment, vacations, life insurance, transportation. So what's the definition of a qualifying person? Well, to qualify for the head of household filing status, a qualifying person needs to live in the taxpayer's home for more than half the year. Only certain types of closely related relatives can be qualifying persons for the head of household filing status. Qualifying person is a child, stepchild, adopted child, a foster child, brother or sister, or a descendant of one of these whom you claim as a dependent under the qualifying children rules. Qualifying person is also a child, a stepchild, adopted child, foster child who's placed in the home by an authorized agency, a brother or sister, or a descendant of one of these whom you would be eligible to claim as a dependent under the qualifying children rules, but choose not to claim as a dependent because you released the dependent's exemption to the non-custodial parent. Qualifying person is also a mother or father who can be claimed as a dependent under the qualifying relative rules, or a brother, sister, grandparent, niece, or nephew whom you can claim as a dependent under the qualifying relative rules. So what's the big deal about filing as head of household, using the head of household filing status? Well, taxpayers who claim the head of household filing status benefit from a higher standard deduction and lower tax rates compared to the single filing status. Next, the qualifying widow or widower filing status. If your spouse died in 2018, you can use married filing jointly as your filing status. You must have a child or a stepchild for whom you can claim an exemption to use the qualifying widow or widower filing status. And you may be eligible to use the qualifying widow or widower as your filing status for 2 years following the year of death of the spouse. Some advantages of the qualifying widow or widower filing status. This filing status entitles you or the taxpayer to use married filing joint tax return rates and the highest standard deduction amount. So in summary, we don't typically think about our filing status till we file our taxes. However, filing status could change during the year. It's important that we use the right filing status because it can definitely affect the amount of tax we owe for the year. It may even determine if we need to file a tax return at all. The marital status on December the 31st is your filing status for the whole year. And sometimes more than one filing status may apply. When that happens, you'll want to choose the one that results in the lowest tax. There are 5 filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying widow or widower with dependent child. Filing status selection can impact the amount of tax, credits, and deductions on your tax return. The single filing status. This status is for taxpayers who aren't married or divorced or legally separated under state law. Married filing jointly. If taxpayers are married, they can file a joint tax return. When a spouse passes away, the widowed spouse can usually file a joint return for that tax year. Married filing separately. The married couple can choose to file 2 separate tax returns. This may benefit them if it results in less tax owed than if they file a joint tax return. Taxpayers may want to prepare their taxes both ways before they choose. They can also use this filing status if each wants to be responsible only for their own tax. Head of household filing status. This status applies to a taxpayer who is not married, but there are some special rules. For example, the taxpayer must have paid more than half the cost of keeping up a home for themselves and a qualifying person. And the qualifying widow or widower with dependent child, this filing status may apply to a taxpayer if the spouse died during one of the previous 2 years and they have a dependent child. In most cases, a married couple pays a lower total tax amount if they file a joint return. If they choose to file separately, they're required to show their spouse's name and social security number on the return. In general, the head of household status is for unmarried taxpayers who paid more than half the cost of keeping up a home for a qualified person during the tax year. However, some married taxpayers who lived apart from their spouse and provided for dependent children may be considered unmarried and qualify to file as head of household. A widow or widower with 1 or more dependent children may be able to use the qualifying widow or widower with dependent child filing status, which is only available for 2 years following the year of the spouse's death. Next, now I'll be quiet while you go over these review questions here at the end of this first module.